Welcome to the Finance Podcast. The topic of this episode, Spotlight on Innovation, a closer look at digital asset products by Bruno de Souza, Stefan Höchle and Olga Miler, moderated by Leon Curti.
I'm Bruno Souza. I'm the head of US and Europe at Hashdex. So Hashdex today is one of the largest crypto asset managers globally. We manage ETFs, ETPs, funds here in Europe, in the US, in Latin America. We're very focused on index investing in crypto. That's our preferred approach. That's how we think most investors should approach it too. And currently we manage the largest crypto index ETF in Europe, the largest crypto index ETF in the US, and the largest crypto index ETF in the world. So we like to talk about crypto indices. And yeah, happy to share some of our visions of what's happening on the market globally. Yeah.
All right, thank you. So when we talk about digital asset products, I think there's no way around talking about the behemoth, the Bitcoin ETFs in the US. They manage roughly $100 billion in assets right now after only a year of launching, which is unheard of. And the first thing I want to know from all of you, maybe we'll start with Bruno, is why you think those Bitcoin ETFs were so successful compared to other products that already were on the market.
There was a lot of repressed demand. I mean, sometimes people make a comparison with Europe and say, oh, Europe, the products are not so big, but there's roughly 10 billion, today a little bit less, in the crypto ETPs in Europe as a whole. So it respects a little bit the proportion of what we see in other asset classes. The thing is that you've seen products like this in Europe for almost 10 years now, and the US market was out, right? So it was expected that this push was going to happen for us, that are in the industry. Maybe the speed took everyone by surprise, how fast it came, but it just showed how much people wanted these products. And it's still the beginning because there's still a lot of work being done on the background with financial advisors, with the wirehouses, with the banks to connect these products and allow the investors to access them. So it's not like the pipes are fully connected or this is not being added yet. It's beginning to be added to the model portfolios, which is a big driver in the US. So the numbers should go up, especially with everything that's happening in regulation there. So good story. Europe has been lagging in the past, I'd say, 15 months. But it should come back up once we see new all-time highs coming.
Yes, I think it was, first of all, the regulation hurdles which were there in the United States. Institutions from the States, they needed to have, first of all, listed products on their exchanges like NASDAQ and New York Stock Exchange, and also familiar names. And what else is familiar when not BlackRock and Fidelity joining that space? So I guess that was very important. And regarding the acceleration, I think it's really remarkable if you see at the moment the volume into crypto ETFs or Bitcoin ETFs in the United States is over 100 billion. Gold ETFs, which started in the 90s, they needed 10 years to get to that stage. So we are like 10 times faster, which really shows you the demand is here from institutions, especially not only from the United States, but from international side as well.
And I think it makes it incredibly easy. Okay, it's super simple product, super easy to explain, super easy for people to understand without any of hassle of keys and all of that stuff. And it was like a stamp of approval. Okay, these ETFs passed the regulation, so crypto is here to stay. So now everybody can hop on the wagon. And so everybody that was kind of hesitant, thinking, maybe, maybe not, actually did, including the institutionals. I mean, when these ETFs came on board, in Switzerland we had players that basically you can put a crypto Bitcoin spot ETF into your Pillar 3A, right? Has never seen before. Before it was like this, they are this crowd. All in a sudden, it's possible. And I think because they are so easy and super cheap, it helped to kind of pump the volume. both institutionally as well as from the private investors.
Yeah. Do you think the brand names BlackRock and Fidelity also played a role in it?
Yeah, for sure. If you look at the size, and you had essentially 11 ETFs launching around the same time, the same days. So the fact that BlackRock and Fidelity took off is just not the brand from the general retail crowd. It's more actually what the advisors can do internally and the asset managers they can invest in and allocate in. So that was an easy choice for those that didn't want to choose among new different names. So these two took off by far. Then you have 3 more in the second tier and the rest in the smaller tier. So yeah, definitely played a role. Speaking as a competitor to BlackRock in a sense, it's both a blessing and a curse. It helps because it's normalized the asset class, so we don't have to have some of the discussions that we needed to have before. At the same time, you have a very cheap product, very accessible. And then as an issuer, our choice has always been with the more complex products that are harder to copy or commoditize, like the Nasdaq Crypto Index, which is our flagship. But in the US especially, it's a very strong brand game. I'd say more than in Europe, actually.
Yeah, I think so too. And the CEO of BlackRock, I think 3 years ago or 4 years ago, he said like Bitcoin is a scam, it's only for money laundering. So if you see the kind of knowledge which is now there in the Wall Street, around the Wall Street firms, it's pretty impressive if you see that names BlackRock and Fidelity joining the space, especially when Larry Fink also is pushing on the fronts of tokenization as well as stablecoins with Fidelity. So there is a lot going on, and of course now with the Trump regime, the new SEC regime, we see an acceleration, a catalyst we've never seen before.
Well, but it also took long enough to buy into the innovation, right? Because at the beginning everybody was like, yeah, it's not stable. And if you look at Europe and you remember Christine Lagarde with the blue background, she got the Bitcoin blues, right? State money will never be invested in Bitcoin, right? So I think it probably took almost like a mindset shift. And to me, these spot ETFs, not only being launched, but then also taking off so well, kind of accelerated also this mindset shift. This is here to stay. We have to deal with this. We have to get familiar with it. We have to start investing in it. Otherwise, we miss the wagon.
Yeah. No, absolutely. I mean, I guess you know that the buyers always attract buyers. And after, 2009 or 2010, Bitcoin is still here. Bitcoin is institutionalized, where the biggest asset managers in the world released ETFs with their name in it, also in Europe now. And this is quite remarkable, and this is reflected in the assets under management as well. And you brought up a good point, by the way. At a certain after a certain size, it's not too easy to handle with all the private keys and everything. So I guess also a lot of early Bitcoin investors went for the ETFs just to have that self-probability of losing their keys or whatever, to spread the risk a little bit more. But especially for institutions, it opened the door to invest in that space. And as we saw how fast this money came, there is absolutely demand here. And when we have a look on all the applications which are now at the SEC I think there are 60 applications for various infrastructure and application layers or different tokens. So that shows you how Wall Street, the appetite is here to invest in the broader crypto space, digital assets, not just Bitcoin.
So apart from just Bitcoin and Bitcoin ETFs, maybe from the buy side, where do you see demand for other products, for other innovation in digital assets?
Look, I think people are still getting educated. Many of them haven't even made, and as we know from statistics, only about 8% even started investing in crypto altogether yet to deal with all the idea of tokenization, where the potential is massive, especially in real estate, for example. But many are still sitting here, figuring this out, trying to find out, where do I start? I get more and more requests about where do I start, which cryptos to buy, etc. This has increased significantly in the past 2 years, but it's like baby steps, right? So this institutional adoption helps a great deal, because if, for example, all of a sudden you get a window of, say, would you like to have 5% Bitcoin in your Pillar 3.8, and everybody picks up the phone and says, should I do it, should I not? So I think we still have a lot of education to do to really educate people. Well, what does it mean not only to invest in crypto, what layers can you invest in, how to hop on the tokenization wagon, and basically this will probably take another 3 to 5 years until people are fully kind of in sync that this is a whole new world that is not just Bitcoin. So I think step by step, but most of the people I meet haven't even grasped the full potential yet. We're still in the early adoption thing, even though to us it might seem like a very obvious thing, but it's actually not.
Yes, that's true. That's true. I read a statistic where around the world the adoption just for Bitcoin is around 3 to 4%. United States is a little bit further, I guess, also because of the new pro-crypto regime. Around 10%, but that's still early. In fact, that's the early stage of the exponential adoption, right?
Absolutely, and many people are also afraid. I mean, we have to be mindful that, at least on the private investor side, many people also have lost money in scams, in exchanges being logged, in all of these kind of things. So it doesn't come like without, this is just the golden age, right? Many are also very skeptical in that sense, or made a bad experience. So that's why I think educating people well, showing them how they can include crypto into a portfolio, do it mindfully, do it risk consciously, I think is probably the way to go. That will unleash a lot more private assets at least.
Yeah. So the market in practice is very much still a retail market. Okay, so you have the professional investors, the large hedge funds, Millennium, Bridgewater, guys like that. There's Bitcoin, and that's it. Okay, so that's what they trade. When you sit down with the private banks here in Geneva, even the tier 1 banks, it's still Bitcoin. The others they have, mainly Solana, Cardano, XRP, ETH, those have, their backing is fully retail, depending on the moment, and you see them come back again. And then you have some windows, you have a specific asset that comes along, which is SUI, things like that. But there's an overestimation of the crypto crowd on how much the general investor understands and invests in crypto. So it's still very limited. The professionals are still very limited to Bitcoin. We're seeing the beginning of the transition into indices, which is what we do, because how do you navigate that? How do you choose which one's going to be next? So in a market cap weighted index, they say, it's mostly Bitcoin, but you have the optionality of the rest. But even this, which is an approach that institutional investors like a lot, it's still niche. It's still something that it depends on them being in a deeper stage. And this is normal. It will accelerate in the US because of the US this year. So we were with the crypto task force in the SEC last week. The message is very clear that, essentially everything's going to be approved. We're going to see all these ETFs come out. They're being very proactive. They want to, I think, chase what happened in other countries globally, here in Europe, in Brazil, some other places that were more advanced. So we should see ETFs of these assets coming out in the States this year. And then that's, prime time, that's the big show. And we'll see the actual appetite for a lot of them. And it doesn't exist for a lot of them. It exists for the few higher up and top, but you're going to see wrappers for all of them. But it's still early beyond Bitcoin.
Yeah, I think this is exactly why we launched this kind of broad, diversified index ETF, because if you see the capital which is coming, which is waiting to be invested in, let's say, the other part besides Bitcoin, which is about 40% of the total market capitalization, it's here. This demand is here. And because of some kind of regulatory arbitrage, people are waiting for SEC approvals. Also in Switzerland, I think you have only 15 tokens which are approved by the SIX, the Swiss Stock Exchange. And so if you want to take advantage of that kind of regulatory arbitrage, you should invest now into that space. But of course, for the investor, as you said, it's very difficult to differentiate between these millions of tokens existing. I mean, we had, I'm sure you know that, but on Solana there was like a platform, Pump.fun. They issued like 25,000 tokens every day. So this kind of stuff is not sustainable. But if you go back to the top 50 cryptocurrencies, for example, they represent roughly 95% of the whole space. So even investing in the top 50, you have a very broad investment into that crypto space. And we think you should invest now because, as you said, Wall Street is coming and they will. It's a 180-degree difference between the SEC before and the SEC now. Maybe you can support that. You spoke to that.
Yeah. So it's a new era, and that connects with price action. I think a lot of people are expecting to see what happens with the next products. Bitcoin is connected to macro environment, so it's been a risk-off market in the past couple of months. It's been trading sideways as a normal part of the cycle. If you look at the numbers, Bitcoin crypto generally delivers its biggest returns in 5 days a year. So those are the days you have to be allocated in. It's much better to just buy and hold and try to time the market. It's very hard to time the market. But the base case that we had going into the election and before is actually stronger by the day when you see the advance of regulation in the US. You see that all the regulators are super pro-crypto and things like, SAB 121, which was a rule that prevented the US banks from actually working with crypto and offering crypto. This is gone. So you're seeing CEO of Bank of America mentioning that they'll probably work with crypto soon, with Bitcoin. Once you have proper gatekeepers in the US opening up everything, crypto trading, direct crypto trading, services to the crypto issuers like us, then the market will go to a completely new level. But there's a little bit of patience that you have to have into these things. So case stays the same, which is long-term, small allocation for us buying the market and don't try to pick winners. And be patient. Be patient with the ups and downs.
One more thing I'd like to touch on is demographics. There's kind of this cliche that the average crypto investor is the 20-year-old surfing TikTok, buying meme coins. Meanwhile, the boomers, they call them, the older generations, they don't care about crypto at all. Is there any truth to that cliche?
I personally think absolutely not. There is probably more a mindset thing. The people that I meet that are very interested in this asset class, they strive for innovation. They usually also are the early adopters. They also are the guys that got into AI early, that experimented with the metaverse, so that are interested in, for example, what's happening in healthcare. So I observe more a correlation on an innovation-oriented mindset, and to a certain extent also the willingness to take some risk and having the mindset also to have patience, to understand that not every up and down, means a tragedy, rather than this being strictly linked to age. I have people that start investing in crypto at the age of 20, and I have a grandmother that is 72 and she's still going for it and super happy with it, right? But they have this one thing in common. What is very important is to explain the volatility and the risk that you take with this, and especially if people operate with smaller amounts, naturally, to kind of protect their thing. Is no use to anyone if you have 80% of your retirement funds in Bitcoin, unless you did it kind of very consciously, right?
Yeah. So we have numbers from different sources. From our source, today we have 350,000 investors, right? And we have some research in some of the markets that we're in. Clients are still mostly men between 30 and 50, and I think the crowd reflects that a little bit. So there's a little bit of a gender skew there, more towards men. But the age group is interesting. We're not talking about 19, 20. We're talking about 30 to 50. This coming into the ETFs and funds. If you go straight to crypto, then you'll probably see 20 to 30, most likely that. Some of them, not necessarily Bitcoin. Bitcoin is, let's say, it's the safe haven. And there's a little bit of a financial nihilism of meme coins and stuff. That's, of course, that's the younger folks. That's not normally a 45-year-old, guy aping and going full into some, I won't mention the names because they're ugly, but some ugly named coin. But there is a growing expansion of that base. So we ran a big research in Brazil with Coinbase that came out a couple of weeks ago. And in Brazil, for instance, the number that you were saying is around 19% of Brazilians invest in crypto. That's more than stocks. So it's been there. It's been very normalized as an asset class. In the U.S., if you look at Coinbase numbers, they're big too. They're roughly always between around 10-15%. So the number is coming up, and at some point it will be part of everyone's portfolio. Not everyone, maybe you're a stock investor, you don't like gold, you don't like bonds, but you recognize them as asset classes. With crypto, it would be the same thing. It will be a normal part of a portfolio, and people won't think twice. Maybe real estate funds is a good reference. You have some people like it, some people don't like it, but it's normal. And that's probably where the market is going. So a lot of money that today is in the sidelines will start coming in, and then you can speculate on where the prices go. But it's money today that's in the more innovative, aggressive investors will go into very, very mainstream. And I think we're in the beginning of that process.
I also think regarding demographics, it's if you have a look at the age group who is really interacting with crypto, with wallets, I guess, and what numbers show, there is a lot of bias with Gen Z and a little bit older. If you go to investors, like mentioned before, of course they are managing portfolios. These are more in the age group 30 to 50, of course, because these are financially educated and more, from approach side, they're more sophisticated. But at the end, if you have a look at wallet addresses, for example, in Bitcoin, you see that with each correction we had, that short-term holders are selling Bitcoin, and long-term holders, whales, so-called whales, with more than 1,000 Bitcoin in the wallet, they were accumulating. So we already see the shift in Bitcoin from, let's say, retailers to more or less institutions, and I guess it will be the same with other cryptocurrencies. It doesn't have to be all the coins he mentioned, some meme coins, but I guess especially with the whole smart contract sector, Solana and so on, we will see the same evolution as we see now in Bitcoin. So coming back to demographics, I think interacting with crypto, of course, it's the younger folks, but coming back from the view of a portfolio manager, these 30 to 50-year-old males, most of the time, these are allocators, these are longer-term investors as well.
And it's exactly from these folks that I would wish for more curiosity and more education in that sector. Because one thing is, yes, the young people striving, etc., but inside the permafrost, inside the bank, I work for the bank with the big red logo. You can imagine, we started to shout to get familiar with crypto. It was when I left in 2015. Right, it was like, we're not going to touch this. It was this Christine Lagarde type of approach. Okay, we got the Bitcoin blues with the blue background. I really wish that financial services professionals would have the courage to educate themselves, to familiarize themselves, and to drive innovation. Also in the larger institutions that are now starting to lag, right? Not just the innovative ones that sit here on the panel.
That's because one of our services part is education. We felt that. We have a lot of contact with financial institutions, and we feel that not only from the relationship manager side, but also from the asset managers or the portfolio managers itself, that kind of education is sometimes needed just to show how the market structure is, how it is traded. I think there is still a lot of lack of knowledge, but of course we have to be honest, the price is always a driver for that education as well. So as we understand, most of the pressure to have getting some knowledge around digital assets came from the client side. So the clients were asking their relationship managers, what shall I do? Shall I buy Bitcoin? Shall I buy other cryptocurrencies? So they had to move because of the client side. And I guess it will be the same in the future. A big wake-up call was the entrance from BlackRock into the space. I guess the next big wake-up call will be all the ETFs being approved, which give a broad experience for other settlement layers, application layers, tokens. And so we will see these people getting more and more into the space. And also I think this is the chance for the investors here to have that kind of possibility to invest now into that space and not when the floodgates open in the United States, and they will.
Yeah, we have about 10 minutes left before we start a new topic. I'll see if there are any questions in the audience. If so, just raise your hand. If not, I'll ask each of you for a quick outlook for the next 12 months. What all of you think are going to be the main drivers, both in terms of market prices, but maybe also in terms of fundamental adoption. Let's start with you, Bruno.
So I mentioned before, we're still in the risk-off environment in general. So that of course affects crypto prices. We've seen some good resistance that Bitcoin in particular has been holding on to some levels, and maybe you'll continue to do that. There's some talks of going back to QE, so more liquidity. I think the biggest correlation in Bitcoin prices in general is with the level of liquidity globally. So if in your model you think there will be more liquidity in the world, you should assume that crypto prices will rise too. And you don't need to understand the tech behind it. And that's a little parenthesis because what you were mentioning, I would say as somebody that's from finance or in the mix of finance and tech, is that people from finance are really bad at tech. Really bad at tech. And this I'm talking about globally, every bank, like it's a very, I'd say, superficial coverage when you compare what you would have from a venture capitalist, of understanding base technology, what happens, where this can go. So there's narratives that keep getting repeated. One now is AI, everybody talks about AI, but nobody really knows deeply what they're talking about. And that affects crypto too, right? But taking aside that little rant of mine, if you think the world will go back into a risk mode, and you think there will be more liquidity, there's a place for a tactical allocation given the time. More than that, if the crypto cycles repeat themselves, we're still in the middle of the bull run, and it would go up until the end of this year. If it repeats itself, there's a chance that this time is a bit different just because of the random factors of the US. It's very different this time around, what you have in regulation especially. But we saw Trump's kids, building crypto mining companies. So it's a completely different world than we had some time ago. So the US is a driver right now. In terms of fundamental adoption of the protocols, there's still a long way to go. Things are more mature than they were in the past. The thing that I can touch and see that is getting traction, real traction, for, although it's a cliche, but now we're seeing actual movement, is on the tokenization side with the money market funds from BlackRock, from Fidelity, from Templeton, big funds, billion-dollar funds, really starting to get some action there. And maybe that will be the first bigger use case after stablecoins. And I think that's one big driver, although they tend to affect only the protocols that are related to them. And we saw prediction markets that were crypto projects too. So this is a year that we should probably see a couple more real world use cases of crypto coming along. And the projects that benefit from that will grow. And on the financial side of things is liquidity. So I said a lot, but essentially we're still bullish, still looks good, but it will be choppy along the way. Yeah.
That's pretty much our view as well, of course. I mean, if the broader market is in a risk-off environment, I think cryptocurrencies don't have a chance to outperform the broader market. In fact, if you just have a look at Bitcoin has a higher correlation to Nasdaq than to gold. So, I mean, giving these aside, putting these things aside, if we don't have World War III or whatever, the chances are pretty high that, as we heard with all the adoption happening in the United States, in terms of institutions coming into that space, in terms of new ETFs getting listed with a lot of infrastructure and application tokens being accessible for Wall Street, but also regarding the adoption of blockchains itself. I mean, you mentioned stablecoins, by the way. That's one of the biggest cases I think people don't really get at the moment, because basically it gives everyone on the world access to US dollars and even to US money markets and treasuries as well, if they have a handy and an internet connection. So that's kind of a game changer. In fact, there were more volumes in stablecoin than whole Visa transacted in US dollars. So this is kind of a statement, I would say. These are some figures which really shows the adoption of blockchains, because this traffic is on public blockchains. So the most traffic from stablecoins were on Tron, Solana, Ethereum, and Base. So these are all tokens. Base doesn't have a token, but the rest, these are tokens which have already ETFs in terms of Ethereum only, but the rest is waiting for ETFs, and the Wall Street is waiting to invest into that space as well. So regarding what do we expect in the next 12 to 18 months, I mean, we don't have a crystal ball, we don't give price targets for Bitcoin, but if you have a look at the total market capitalization, which is at the moment around $2.6 trillion, we think there is a really good chance that we reach 10 trillion in the next 12 to 18 months. So that's, I guess, quite an interesting investment thesis for a portfolio allocator. And for us, it doesn't matter, in which sector you go. It's a long-only play. We think you should invest diversified, but it's a long-only play for the next 24 months.
I expect short-term a correction. Small correction, but I expect a small correction. And long-term, does it really matter what it short-term does? If you believe in the case of the digital assets, then probably no better point in time than to start investing now and just do it staggered. We always thought, people always ask me, say, is it too expensive? Is it too expensive? They were asking, is the Bitcoin too expensive at 8,000, at 20,000, at 50,000, at 100,000, right? I think the overall use case still remains intact. And if that is what one fundamentally believes, then just invest staggered, diversified, and don't stop investing just because there is some tiny correction along the way, right? Because otherwise you feel sorry afterwards. So in that regard, I think all lights on green. Let's just get investing and pump that volume. It's going to be good for all of us.
Yeah, I mean, the volatility at the end shouldn't be a hurdle for an asset allocator, because you cannot invest into an asset where you expect a 4 or 5x this asset will have a volatility of like 70 to 80%. It's not going to happen with a bond which is a historical volatility of 10. So, you can steer that with the weighting into the portfolio. So if you allocate like 2, 3, 4% of your portfolio into crypto asset, you should be happy with the volatility in it. It shouldn't bother you, let's say like this. That's the opportunity. Volatility is the opportunity.
Well, and that said, if we look at the current behavior of the S&P 500, for example, I think it's nothing short of volatility, so maybe that is something we just have to learn to live with for the next 4 years.
Absolutely.
You don't need to go into Bitcoin or crypto to get your fair share of volatility, right? So.
You mentioned something interesting about timing. People always think they're too late. They always think now's not the right moment. So I think we have time for one last question for you, Bruno. Do you think people should even care about timing? Does it matter whether they invest now, whether they do it in 6 months, whether they do it in 3 years, or should they just invest as soon as possible?
How do you time the market? How do you time any market? If you know the best moment to go in Bitcoin and go out of Bitcoin, so buy when it's cheap and go out, when it's expensive, you should be a portfolio manager at Bridgewater, right? So I can say, we have a firm that, we've been around 7 years, working just with crypto, great team, everybody deep into crypto. You'd be hard pressed to find somebody in the firm saying, this is a good time, this is a bad time to come in. We have general feelings. The general feeling right now, this is a good window, the trend is up, right? But don't try to time the market on the many things. We always tell the story of a client that was coming in when Bitcoin was at 3,000. It was like, oh no, maybe I'll wait a little bit more so it goes down to 2.5 or something. And he never came in. And this was a big position he was going to build. So you always know the size of what he lost. Based on that, I'll try to time it. So I say the broader cycles you can sort of understand. If it's a bull run, if it's a bear market, this is very clear. And if you look at what everyone projects, everybody that's a little bit informed about crypto projects, this is a strong year. So this is a point as good as any, 80-something thousand. I can always tell from a personal perspective, I'm buying 80-something thousand, I'm buying. And if anyone has a position thinking that they should sell right now, you can talk to me afterwards and explain why, because from the best crypto traders that I know, that's not the case. The best crypto traders are saying a similar thing, that the patterns, they look good. So, and then, as she was saying, build a position slowly, come in. It's what we see from our professional investors, asset managers. They make a decision that they want to have 2% of the portfolio. They're not building that in a single day. They're building that, cost averaging over a few weeks. And that's okay, and then you live with that. There's always a better moment, and there's always a worse moment. So.
All right, with that, we're on time. I think it's getting too late to stretch it even more. So I'd like to thank all of you for your great participation. I'd like to thank you for your attention. And with that, I think all of you will be around for another 15 minutes. If any of you have personal questions, you can ask them right away. Thank you.
Thanks.
Thank you.
Thank you.
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.